Hi, Jeff. As to your question, who qualifies for a non-QM loan? Let's first start by defining what a non-QM loan is. Non-QM stands for non-qualified mortgage. The importance of that term has to do with back in 2010, when the Consumer Financial Protection Bureau was created, a whole new set of underwriting rules were established for U.S. residential mortgages. And a big focus of those rule changes was to create or focus on the concept of ATR, or ability to repay. That meant calculating, actually documenting your recurring stable monthly income and then calculating a debt ratio against that. If you don't meet the ratio, then you would have trouble qualifying. So that's a qualified mortgage, those programs that meet the Fannie Mae, Freddie Mac qualified mortgage guidelines. That's how that is done. Now, there are a lot of borrowers, however, who do not meet that kind of criteria for qualifying based on ability to repay and meeting a debt ratio, even though their specific situation will involve a pretty significant amount of cash flow that should be taken into account in qualifying, but maybe in a different way. That's what the non-qualified mortgage segment provides. It provides loans that are going to be made based on different underwriting criteria, different ways of establishing that borrower is a good credit risk. These loans in general are considered low doc loans, meaning they in most cases rely on less documentation than the conforming qualified mortgages. Now, who would be these type of borrowers, or who would be the type of borrowers that this type of loan would help? Well, think of it. The most common, obviously, is self-employed borrowers, business owners. They have always been historically a class that's had a difficult time with mortgage qualifying. This provides them much more options. You've got freelancers, gig workers, Uber drivers, Lyft drivers, etc. You can have folks who are working for cash. You can have folks who have a lot of liquid assets but limited monthly income, whether it be from a job or from retirement and so forth. You have folks who are independent contractors getting paid on a 1099 basis. And of course, then there's the I-10 borrowers. Those are borrowers who have a taxpayer identification number for purposes of paying taxes, but they don't have a Social Security number. So the non-QM space serves all of those types of borrowers who otherwise would be shut out of any sort of reasonable mortgage financing to purchase and own a home. Now, is there a trade-off with the non-QM product? Yes, of course. Non-QM products are encountering or taking into account more risk that borrower profile provides, but they've determined and figured out a way to establish underwriting criteria to adequately address that risk, but that still results in the type of terms you're going to get are going to be a little bit higher, both in respect to down payment as well as your interest rate. And not terribly, much higher, but they're going to be higher. The mortgage rates on a non-QM product, generally speaking, I would say are going to range anywhere from half to maybe as much as 2% on rate. That's going to depend on your loan to value and your credit score. And then in terms of down payment, you're not going to see non-QM loans that are going to offer you, 3.5%, 5% down as the conforming, FHA and so forth offer you. But still, the down payment requirements in a lot of cases are relatively modest. In most cases, you're going to see a minimum down payment of 15% or more. Again, depending on your credit score, that will increase your down payment requirement. So by and large, it's a question of trade-offs. If you're a business owner and you're running a business that's doing very well cash flow wise, but you're very aggressive on writing off your business expenses to show a very low net income, that's a terrific strategy to reduce your federal income tax liability. But it directly conflicts with the criteria to get qualified for conforming mortgage. The non-QM type product will fill that gap and give that otherwise highly successful business owner a way to get financing to, again, purchase or own a home. A little bit higher rate, sure. A little bit more skin in the games in terms of cash out of pocket for the down payment, yes. But the trade-off is you're still going to be able to have that very aggressive income tax strategy while at the same time get reasonably priced mortgages for your unique employment and income situation. So I hope that helps explain why non-QM mortgages are a very real part of the mortgage industry, and they're a great opportunity to serve an otherwise underserved market. Thank you.